Now we will go through the EIA data, what is happening within the U.S. on demand, on flows, imports, exports, a lot of the fun things when it comes to refined products in the U.S. So before we do that, it is now official. Evergrande has defaulted. The 30-day grace period is now over. We'll talk more about that on the Econ show, but it's just going to show you that there is continuous stress within the system. And one of the funny thing is that before we get into this, a lot of individuals who are super bearish China are also really bullish crude prices, and I always think that those two tend to be contradictory. But we'll see how that shakes out. But when we look at what the U.S. product supplied is doing right now, you can see we're just right at where we were. Just right above where we were in 2017, and then on that average, we're right where we were on that low end when 2017 had that drop. Still below 2019, but when you start looking at some of these dynamics, the current week, we had an increase to 15.43 million barrels a day of demand versus last week's at 15.326. So again, that pulls our average up to that 4-week rolling average to 15.342 million. So again, we're still right around that bottom end with 2017. One of the things that we expect is it to come closer to that 15 million level, and then just kind of stick around as we go forward. And then we'll obviously get our spike as we head into Thanksgiving, which is when it's the biggest travel day of the year, a travel holiday of the year. We don't see that changing. There is some shift. We are seeing some increases in COVID cases. Unfortunately, my father-in-law did test positive. So he is quarantining, doing the normal. He's fine. He just has a really bad cold, which is what he thought it was until he was like, it's lasting a little bit longer. Let me get checked. Everyone's vaccinated, but these are things that I think are starting to be a bit more of a concern as obviously it gets colder, flu season, COVID, now COVID season. So it's where we sit, and that's why it's not overly shocking, but it's just going to be a matter of what is the overreaction? Do we have an overreaction? But again, that's just going to kind of mute some of that capacity. And when I say mute, I just mean that instead of getting a move up, we just kind of go sideways, because some people are like, well, maybe I just won't do as much before Thanksgiving because I want to make sure everyone's fine so that we can celebrate. So you might see a slowdown to get that big pop versus what we normally see of a little bit of an increase ahead of it, and then that big spike, and then we come down as we come into the lull of December before obviously we get our Christmas movements. So just as a reminder, November loading shipments of clean fuels from Asia to the U.S. rose. We expect that to continue to climb higher as PADD 5 still remains a great spot for product, given the fact that, prices in California are just absurd. But we'll talk about gasoline and diesel prices in a moment. So now when we look at distillate, so distillate had a draw of 2.61 million barrels. That brings us 7.2 million below the 5-year average. But then when you look at the breakdown, of that 5-year average, there's PADD 1 is 10.9 million below the 5-year average. So PADD 2 is 2.6 above, PADD 3 is 800,000 above, and then PADD 4 and 5 are essentially 200,000 above. So you're seeing that it's really that PADD 1. And remember, Philadelphia had a refiner literally explode, and now that is completely taken down, which is creating some of these struggles, because there's just not enough capacity to fill that void. The Jones Act vessels, how much of them can move through, how much rail capacity is there to go from PADD 3 into PADD 1A. These are some of those important shifts as we look, which is why PADD 1 is going to continue to see a lot of those imports, which is why we talked about not only just Asian imports, but also European imports and Asian imports into the Atlantic Basin. And how there'll be that competition between, do I go to Europe? Do I go to the U.S.? So distillate had an increase of 88,000 barrels a day of imports. That's 90,000 above the 5-year average, all driven by PADD 1 that had an increase of 93,000 barrels a day. Now, when we look at the underlying production of distillate was slightly down, and it's funny just based on yields. So production was technically down almost 50 basis points, but the actual throughput was increased 35,000. Again, it all depends on what process is being run. And then gasoline production was down 2%, but the production was actually down only 85,000 barrels. And it all depends, again, just what is being worked on, how is it being worked. And so we do expect to see a gradual movement up in distillate, but distillate production right now is right in line with the 5-year average, with gasoline production slightly below the 5-year average. But again, we expect that to climb higher as we go through and come out of shoulder season, and we see that reacceleration as refiners come out of turnaround. Now, here's what we were expecting. As we said last week, we expected a movement back to the 5-year average. Here we are. We do expect this to remain elevated. It's just going to be a matter of timing as to when does it. We should get a movement down, but it's just not going to be a big move down. It's just going to be stay within the middle of that cloud, and then we'll kind of follow that normal 5-year average. But still, at the realistically, when we look over the next 4 weeks, we expect to average above the 5-year average. So we're not going to. We'll still move with it. So we'll still see a decline. It's just not going to. It's just going to be a decline that is above normal. That is below normal, because we will have that demand from the trucking side. And here's just looking at the trucking component, still remaining elevated. Load availability is right there. You're starting to see those rates creep back up. And you're starting to see more of that get pulled through, just because there's a lot of shipments that have to move. There's still a broad shortage of truck drivers, which we're going to talk about in the econ show, which again is just keeping those rates bid as diesel prices remain near all-time highs. So now when we look at rail traffic, car loads came down a bit. They're at 3.1% versus 2019. Intermodal I really can't get out of its own way, and so it's still 8.6% below 2020. Given 2020 was a big movement, but the hope was that you were going to see more of this clear. And as we've been saying, that there's so much congestion, there's not enough people. Rail guys have been cutting, rail companies have been cutting employees for 3-4 years, and again, some of that. When we looked at Q4 of 19, there's questions started to get raised of, well, should you still be cutting people? Like, have we reached a point where the efficacy on managing and automating is starting to come through, and now we're at a point where they can't hire people fast enough, and that's not to say that they're the only ones, because that's a very common backdrop right now. But then when you look at the background, coal remains elevated. It's going to stay that way. Grain, based on what last year will remain strong. Metallic strong. Motor vehicles going to remain weak. That should start to increase a bit as we get a little bit more of movement on the chip side, semiconductor side. And then petroleum and petroleum products, again, that movement as we get some of that adjustments through pad 3 into pad 1. Realistically, year to date, still elevated. The intermodal units, we still expect that to continue to accelerate. We expect it to close the gap and be only about 3 to 3.5% below 2020, just because there is, again, that demand, but it's a matter of getting it off the boat, getting it on in the port, getting it from the port to either rail or the truck that is waiting. And then on the port side, you can see that we still have a lot. So when we look at November 7th and November 13th, we're only 30 basis points below the previous year. And then when we look out through the end of November, you can see that we're well above normal, continuing to be above normal, and some of those additional cargoes will continue to show up. So between November 21st and November 27th are still going to be elevated. And we are seeing those obviously those extended wait times continue to pile up. Now, when we shift to the temperatures, you can see here that when you really look, west of the Mississippi, I was about to say west of the Suez, but we're looking at America. West of the Mississippi, you're going to be a bit above normal. And that's just looking 6 to 10 days out. If you go to the 8 to 14 days out, a little bit cooler. But then we get some cooling into the West Coast or east of the Mississippi. And here you can see that it's a little bit cooler in the north, and then much cooler in the south. So there, again, is just going to be a mixture of, we lost, I think the estimate right now is for about 36 heating degree days within November. So there's some conflicting news. There's some views that we're going to get a decent polar vortex into the end of November, which will come down and create a very big event from essentially Minnesota across to the Carolinas. The question is going to be, does it happen? Is it something that's going to move and change? So far, it's changed a bit, with the polar vortex tightening up a bit. And remember that all the polar vortex is essentially, think of a hurricane and a circular movement at the top of the world. And when we get the polar vortex, when that swirl kind of breaks down and you get a dip, and that brings Arctic air into obviously Canada and the U.S. But these are things so far that we're seeing. We'll obviously update you on a weekly basis just to look at how flows are doing, because this is going to be important for heating oil, propane, natural gas. So right now, fairly normal, nothing too crazy when we're looking at the heating demand. And, those are things that are going to shift. I don't claim to be a weatherman. I just report what I see, talk about what I see. And so far, this is just the what has been put out by the weather agencies. Gasoline had a small draw of 1.55 million. The draw was driven by Pad 3, which had a draw of 1.82 million, and Pad 5 that had a draw of 480,000. Pad 3 is now right in line with the 5-year average. Pad 1 is the one that has the biggest shortfall versus the 5-year average of 6.1 million. Imports, as we said last week, dropped as expected. We had a drop of 80,000 barrels a day. And that was really driven pretty much across the board. We expect that to remain fairly stable, come in a bit lower, because we're still 141,000 barrels above the 5-year average. We should see that drop a bit more and come closer to about between 450 and 500,000 barrels a day. And the reason why is because we're at a 2-week low for European imports. So it's just going to, it just takes a week or so to show up. So again, that's going to be the drop. When you look at it against the 29-year average, we're right in line with kind of where we have been in the past. And then here's where you start to get that slowdown, just because as you increase heating oil, distillate, you inherently throw off gasoline. So that's when we'll start to flatline, and we'll see storage start to increase. When you look at gasoline demand based on Gas Buddy, there's a slight bounce. According to Gas Buddy, Sunday to Saturday, U.S. gasoline demand rose 0.8% from the prior week and was 0.9% above the 4-week average. This is where we've been saying, a little bit above, a little bit below. We're just going to kind of sit within this range. We expect it to come down a bit, just as things slow down before Thanksgiving, but again, still well within this fairly tight range as we go through the end of the as we go into Thanksgiving. This is going to be the bigger issue. We actually had real wages drop precipitously this past today. So in October, real wages dropped 1.2%. Weekly average rate, weekly wages dropped 1.6%. So again, even though we still see wages going up, they're just not keeping pace with inflation, as inflation had a huge surge, and we'll talk about that in the Econ show. But we did it, as we said, we were going to break $3.40, and we're at $3.41. Now, not to play any political game, but I do think this is the top. I don't think we go much higher on gasoline prices. I think if anything, we kind of come to that 341, and now we settle out closer to about $3.37. I agree with them, with Gas Buddy, with some of their views, just in terms of where some of this is breaking up. And, so the increase of 2 cents, I think we come down about 4 to 5 cents over the next few weeks. But again, we're not coming to $3. We're not breaking $3, even though that's what the EIA said, unless we get some huge drop in crude prices, and or if we get a huge increase in refinery runs. And as we've been talking about, there's no incentive for refiners to run all that hard, based on spreads, and the OSPs that increased from OPEC, again, keeps that the same way. So then when we look at diesel prices were essentially flat at $3.73. Still a huge increase. That's a huge impact for that last mile and for that the national movements. So again, still keeping prices elevated, and that will hit directly into people's pocketbooks. When we look at blending components had a drop of 1.96 million. We're now 1 million below the 5-year average, but you can see just we're right in line with where we normally are, and then we start to see some of those increases as we go through the next week or two, as the blending needs come down. So, there's a slowdown in gasoline demand. There's an acceleration in gasoline creation, and that will show up here. Now, when we look at total products, gasoline demand based on the EIA data, you can see looking over the last 15 years, we're still nice and elevated versus, and the reason why we go back to 2016 is so you can see other recessions, other slowdowns. So we're still elevated, still moving in a positive light. And when we drill in a bit more, just to look at kind of where we sit, we're just below where we were in 2019, but it's just the timing of when some of these drops happen. As we were saying, we thought there was going to be one more move down. So here you got a little bit of a makeup. There should be one more completion to the downside, and that'll take us to the lows. But again, just slightly. We're not looking at these huge drops. It's just within this fairly tight range as there's competition with a little bit less activity on weekends, a little bit less activity during the week, which is just going to pull us back down. Again, just below where we have been on that seasonal norm. And here's what we're looking at here when you look at parks rolling over a bit. When you look at transit stations, workplaces coming down slightly, just very stable when we look at where we have been over the last few months. Then when you look at Apple Mobility, there's been about a 10% drop in pretty much across the board. And you could see it carrying out here. That's just a little bit more COVID cases cropping up in Europe. A little bit less activity in the U.S., but again, just still fairly steady as she goes. Propane/propylene had a draw of 1.34 million, so the draws are starting to kick off. Here's where you start to see that rollover. We're still 12.4 million below the 5-year average, and we're bumping right around the lows that mirrors 2017. And we expect that to continue to accelerate as the days to cover has gotten a bit better, but we expect that to see a drop off just based on where demand is and where current supply sits. Vaccinations remain on pace. We don't see too much change. India is something very steady. U.S., the first shot has increased again, so again, getting closer and closer to 70%. On the jet fuel side, we had a drop of storage of 1.75 million. That's 1.8 million below the 5-year average. And as we were saying, we expect it to move closer to kind of that range. We're right now at the top of the range, and we expect that just to move a little bit lower. But just, again, in line with the seasonal movements, just at a reduced rate versus previous, which continues to play out. Now, globally, flying is getting a bit worse, and it's really driven by Asia, just based on what we're seeing from China. So that's that big drop-off. North America had a little bit of an increase in departures. That comes closely with the reopening of some of the international travel. But we've seen a steady decline in Europe as the rest of the world is kind of flatlined. So it's really because everything is stabilized a bit and come down a little bit based on seasonality. That's why Asia looks much worse than I think if everything else was steady, whereas as it is, it wouldn't look as bad. But the average number of departures per day decreased by just under 1.3%. Year-on-year departures are still up 31%, and departures in the U.S. led growth, while departures in China declined by over 1,000 on average each day. Globally, passenger flight schedules for the 11 weeks ahead declined by less than 1%. This follows a significant drop last week. So we kind of saw that big one last week. So we're still seeing some of these pressures as we go into the end of the year and into the beginning of next year. Again, 11 weeks out, just kind of think of where that sits. In Europe, departures in the Eurocontrol area declined by 5.3% week on week. Spain and Germany registered the largest reduction. The U.S. flight numbers picked up as the country reopened to international travelers. Hub airports like JFK and Atlanta drove the increase. And in Asia Pacific, departures cratered in China again for the second consecutive week, while flight activity in Australia, India, and Thailand increased. So again, it's just timing, but China is going to continue to be that much bigger overhang as we head into year end. TSA passengers, again, we're still right at the lows that we've been at in the past, even before we had that reopening. Again, it's only 2 days in. So this is going to be something to watch. Where are the highs? Where are the lows? Are we getting higher highs, higher lows? And we're seeing that shift up. Right now, we're just right where we were previously, following pretty closely to that seasonal norm. And then you can see obviously the big spike that comes shockingly right around Thanksgiving. So that's going to be something to watch to see how we respond. We've already seen a big increase in airlines preparing for potential shortages. They're offering bonuses to work Thanksgiving. They're offering step-ups in pay just to, again, make sure that they have the personnel so they don't have to cancel flights and make that nightmare occur that we've already seen. Now, when we look at OpenTable, again, something fairly similar that we've been talking about, where weekdays about 10% below normal and weekends, flat to 5% up, and that continues to play out. And it's interesting because OpenTable has been fairly flat over the last, let's call it since June, July, and there hasn't been too much deviation, and we just don't see much changing overall. We might see some because my children's school does a dine to donate, and we like to participate, and the prices are just funny. Like, what we were expecting was, $17, $18 a plate. Instead, it was $27. And it's just, and again, it's just because that's what it was. But obviously, when you looked online, they took the prices away because they probably have no idea what the prices are going to be until they get their orders, just because of the issues on supply chain, inflation, prices continuing to be that upward momentum that we continue to see in the market. So now we've talked about the U.S., we're going to turn abroad and look at what are some of the backdrops that we're seeing in the global markets.